Okay, that's probably 20, 30 seconds. I guess we'll kick off. Right, thank you everybody. Good morning and welcome to the Finance Bill 2023 update. This is purely an aviation focused update. We actually are running a number of parallel Finance Bill updates presently this week for different areas such as structured finance, banking, insurance, and asset management, etc. So this one is specifically on aviation finance. So today, let me just walk you through the agenda and the speakers. So Mick, if you can just change the slide there, thank you. So we have a fairly busy agenda. As you'll appreciate, the finance bill came out about 2 weeks ago. It's a very substantial finance bill, and there are a lot of bits to it. The primary elements are that we think are relevant for the sector are outlined in this agenda. So we will kick off by going through leasing specific updates. We will touch on the qualifying finance company regime that has been introduced. We will discuss Pillar 2, which has been legislated for in the finance bill, and the new outbound payments legislation, which will have implications for the sector as well. Joining me today, I'm John Hannigan, tax partner in EY. I've got my partners, Michael Maroney and Kieran Conroy, and we will alternate between us as we go through the various areas. So without further ado, I'm going to pass this over to Mick, who is going to walk us through the key finance changes for aviation finance.
Thanks, John. Yeah, so we wanted to start with just a discussion on some of the legislative changes that have been introduced that are focused specifically on leasing. And just a little bit of context on this in advance. So as I suppose a lot of people probably in the call are aware, there's been a lot of discussion between Irish Revenue, the Department of Finance, the industry and industry advisors over the last probably 3 to 4 years, dealing with kind of the treatment of some of the historic practices that have built up in the industry over 20 years at this point. The focus of a lot of that discussion was trying to kind of codify some of those practices where they fit within the legislation, and where they didn't fit within the legislation, maybe just a realization that we needed to move to either through guidance or legislation, a kind of a more modern approach to how leasing was being treated. Some of the discussions, probably even up until ones over the summer involving the Department of Finance and Irish Revenue that Kieran and John and myself would have been involved in, we're really looking at this and kind of nearly a wish list of what we thought needed actual legislative change and what just required guidance from Revenue. So we have received obviously a large number of legislative changes, which is welcome and is helpful. And we understand that there will be an updated tax and duty manual issued as well. We've seen drafts of this over the last sort of 2 to 3 years. It's been discussed, all the professional services firms, some of probably the industry bodies as well. And hopefully that will remove then some of the uncertainty that's been there. And like I said, I think it's a movement towards a more legislative-based approach to the taxation of this industry and away from maybe some of the historic rulings. So just to run through some of the kind of the key points from that. So on the first piece, which is probably the most significant change, it's to do with the taxation of kind of leases as a basic tenant. So 76D was the legislative provision previously that dealt with the taxation of finance leases in the hands of a lessor. Didn't discuss operating leases and was relatively narrowly drafted. The finance bill has introduced a kind of a replacement to that section, and it now covers a number of different areas. So the first area is around operating lease income and operating lease expenses and how that will be taxed. And what the bill says is that we are moving from an accruals-based approach, which would be kind of consistent with the general Irish regime, to actually an approach based on the cash payments that were received over the life of the lease. So you would look at the total lease payments that are received, the term of the lease, and spread that lease payment on an even straight line basis over the term of the lease. Now, there is a definition of lease payment within the draft finance bill legislation. It's not overly broad, it's not overly descriptive in terms of it. It doesn't discuss maybe some different variable payments that might be received, and it's probably designed in that manner. There's also a provision that if there's a material change to the terms of the lease while the lease is in place, that effectively you are required to restart that calculation and again spread the remaining lease payments on an even basis over the remaining term of the lease. So, for example, if you amended the term in April of 2024, then you effectively go back to the start of 2024 and rebase your lease as if it started from there rather from an earlier year. So from I suppose from a finance lease perspective, because of some of the accounting rule changes in recent years, that was probably an approach that was already being followed, but it is quite different from an operating lease perspective. And so our expectation is there will be a requirement to do some level of kind of modeling to see what lease income is going to be recognized for tax purposes. And there's also, I suppose, an open question as how that's going to interact with future changes to accounting standards, how it's going to interact with, some variable type payments that may arise over a lease, which may not be known initially, and how it's going to interact with other payments that might be received under the lease that are not specifically called out in the legislation. So, this is one of the points I think where in a very simple case, it should be straightforward. And I don't think, it's a huge challenge, but obviously the majority of the leases will have some element of different payments in them. And so we will probably need some guidance from revenue as to how they're going to interpret definition of a lease payment. The second piece within that is some exceptions to that sort of straight line basis. And this is primarily focused on dealing with a finance lease or dealing with an operating lease, which kind of embodies sort of finance lease characteristics. And the historic position here is that people have generally looked to just tax the financing return under a finance lease, but the legislation that was in place didn't really sit kind of neatly with this. And so it was kind of built up over practice over time that revenue had generally accepted that if the lessor wasn't claiming capital allowances, that they should look to just tax the financing return rather than taxing the gross payment. So the legislation now sort of codifies that, which is obviously quite useful. But there is significant anti-avoidance provisions, and those are in place to ensure that there is an alignment between what is being done from a lessor perspective and a lessee perspective. And the key piece here is around who's claiming capital allowances. And while historically, in the case of a lease to an individual, you were caught by the general requirement that there was an election made by both parties, that's been removed. We should simplify it. Probably not relevant for a lot of aviation leasing, but for other types of leasing, it would be. And in the case of a lease to a corporate, you will continue to have to make that election. And also there's fairly significant disclosure requirements. And the final piece on this, which I think is relevant as well, is that if you are looking at a lease to a non-Irish resident, you need to actually look at the anti-avoidance, which is somewhat similar to, I suppose, maybe the hybrid rules, where you're saying, is what's being taxed on the Irish side consistent with what's happening on the other side of that transaction? And you need to be kind of comfortable that there is alignment between the two of those, allowing for the fact that obviously there's not going to be capital allowances claimed by the other party, or you may not have oversight of that. So I think, that element of it and the disclosure element is probably, I suppose, a significant change in terms of the amount of work that's required. But hopefully the ultimate outcome that you're getting to is a little bit better. So then just to move on to the other primary change that was introduced, and this is to do with Section 403. And again, I suppose recognition by revenue, and that's something that's discussed, that 403 probably was a little bit clunky and didn't deal with the practical reality of how some of these structures worked. So one of the key pieces just around how a leasing group is defined. So 403 kind of provides for kind of one or two different ways that you can have a leasing group for the purpose of the legislation that's there. That's been broadened now that you effectively can construct a leasing group in line with what your corporate tax loss group would be, rather than kind of being focused on a parent-sub relationship. So I think that is quite helpful. It's quite broad. People might be familiar, I suppose, with the general concept of Section 403, but what it's targeted at is making sure that excess capital allowances that you will throw up in a leasing context because of the timing differences between book and tax depreciation don't allow you to shelter non-leasing income. And what the basic section said was that, you were restricted from using those excess allowances against income which wasn't deemed to be leasing income under the rules. And the historic rules kind of allowed for certain other types of income to fall within that leasing income bucket. And the legislative changes have amended that to broaden that out and include some additional points which are kind of mentioned there on the slide around intergroup financing, around the disposals of sort of rights to acquire aircraft, and kind of part disposals. So that is kind of helpful as well in the context of making sure that it's a broader element of income that could fall within the leasing ring fence. The kind of the second part, however, to that updated legislation is there's now fairly significant disclosures that are required, where you're talking about what's being covered by the ring fence, what income is now allowed to be sheltered by it, and how that works. So I think, again, it's revenue understand the concept, revenue understand why this is important in a leasing construct where you may not just have lease income, but actually there's other activity that is kind of core to how you carry on a leasing business, but not itself just the basic leasing income being generated. So I suppose it's helpful that they've recognized that, but I suppose they're just protecting by introducing some of those disclosure requirements. So then just the final piece to mention, but I think this is very important. As I touched on at the very start, the leasing industry has relied upon a large number of rulings and guidance notes in some ways to support tax positions that have been taken over the years. The most basic of that was some of the rulings that were provided around single aircraft SPVs that may have not been part of larger leasing groups, and how you sort of met a bright line test to be considered to be carrying on a trade. Consistent with, I suppose, what a lot of other industries, revenue were uncomfortable that that type of a ruling could give rise to a state aid challenge, could give rise to a challenge that, there was no legislative basis for that. And this was actually just sort of preferential treatment given to an industry, given the importance of it to the Irish economy. So revenue have kind of moved away from that. What they've said in some of those meetings, myself and Caroline were in one with Department of Finance and Revenue and a couple of the other advisors over the summer. And they were quite strong about the fact that, the determination of whether an entity is carrying on a trade will go to general principles. It's unlikely that the guidance manual they'll issue on leasing will discuss the concept of trading in a leasing SPV in a lot of detail. And so you would need to look at that on a case by case basis, and ensuring that you actually have the substance from it. And those precedents have obviously aged out now with revenue having a 5-year rule. So that is kind of a key focus for people, and making sure that if they have taken tax positions historically, that they will continue to stand up over the next couple of years. I think it's probably a welcome change, because the challenge of relying on any sort of a ruling that wasn't based in legislation is it was somewhat determined by the person in revenue you were dealing with. It was somewhat determined by their view at the time. And so it was subject to change, and you didn't really have a supportive basis. So I think this is actually probably quite helpful. I'll bet there is a bit of a change from how the industry will deal with it. The other kind of final piece, and then we'll move on to the next phase, is around the treatment of gains on the cost, gains arising over and above the cost of an aviation asset. So I'm sure, again, anybody here who's dealt with revenue and revenue audits in recent years has come across some of these queries with revenue. And it's a point that they've been very much focused on as to why you would not be subject to tax on these as being a capital rather than a revenue gain. So they've introduced a couple of small legislative amendments to sort of narrow how you can treat that. An example of that is the rules around what is a wasting chattel and what is treated as a gain on that have been narrowed to remove effectively, an aviation type asset or another similar asset you were claiming capital allowances on. And again, they're going back to looking at what is the first principles of how you should be taxed on some sort of a gain on aircraft. And this was also in the discussions with them where they're saying, if you're actively trading in and out of aircraft, yeah, you're building a case. That's part of your trade. You can be taxed accordingly. If it's a one-off, does that really fit that? So it goes back to the earlier discussion on sort of general principles, how this is looked at, but they have narrowed the legislation, which in a couple of places would have otherwise been helpful. Just a final point on this, just to take away from some of those discussions, what Revenue have said is that, some of their sort of approaches to this will be built on revenue audits they will overtake over the next couple of years, where they'll get an understanding of different types of structures. Despite a fairly significant amount of interaction with the industry, with advisors like ourselves, the other big four, the law firms, I think they still don't have maybe a full confidence that they have an understanding of how all the different types of entities work. And so they said that, there will be a build-up of practice through revenue queries, through revenue audits over the next number of years, as to how sort of, I suppose, the principles are viewed going forward. So it's just something to keep in mind for people. I think, some of the changes that are legislative are quite clear, but the piece around trading and around the gains on sale continue to be somewhat more subjective.
And Mick, just before you finish out here, I just wanted, I neglected at the top of the call to mention at the bottom of the screen, there's a Q&A box. If people want to pose questions, please do so throughout the discussion and we can try and handle them at the end.
Thanks, John. So I'll just pass on to Kieran now just to discuss the new qualifying company review.
Cool, thanks, Mick, and good morning, everyone. I'm just going to talk a little bit about the qualifying financing company legislation that was included in the finance bill. Just briefly, it's quite a discrete area, but will be relevant for certain leasing structures. So just for context on these new provisions, the rules around tax deductions for interest are quite complicated now in Ireland. You have Section 130 rules, you have hybrid rules, you have interest limitation, you have TP, quantum of debt rules around interest as well. So there is, I guess, an acknowledgement within revenue that the rules need to be made more straightforward, both for taxpayers and for revenue in terms of administering them. These new rules around qualifying financing companies are a first step in trying to do that, and they basically deal with situations where there's a financing company in the group which is not necessarily trading for Irish tax purposes and therefore doesn't necessarily get a deduction for interest in the course of its trade. The rules provide for a tax deduction for interest in the FinCo, in the financing company, where it borrows from a third party and onward lends to a 75% direct subsidiary for the purposes of its trade. So the lower tier subsidiary needs to use the proceeds of the loan for the purpose of its trading activity. So in a leasing context, you're probably talking about a financing company borrowing third party and lending down to an Irish AOE entity that's carrying on a trade. That would be the basic application of this from an aviation leasing perspective, I guess. So we do see these types of intermediary vehicles in leasing structures where they may not clearly be trading the financing company, and the new rules are definitely helpful in claiming a tax deduction for interest in that circumstance. We do also sometimes see Section 110 entities being used for this financing purpose. So the new rules, I guess, provide an alternative to that for the FinCo. So they are definitely a welcome development and will remove some of the uncertainty around this in leasing structures that we see. However, it's just important to bear in mind that the rules are quite tight. So it has to be a direct subsidiary. So the FinCo must borrow externally and lend to a direct 75% subsidiary. And it must be used, the proceeds must be used in the course of a trade of the lower tier sub. So, and there's some strict anti-avoidance there around, paying off loans and still claiming deduction on the intermediary loan and that kind of thing. So just important to be aware of that detail, but definitely a welcome development. And it is definitely relevant for some of the leasing structures that we see with intermediary FinCos in them. So that's it on the qualifying FinCo.
And Kieran, presumably it will reduce to some extent reliance on Section 110s, which is probably what the Department of Finance are motivated by, actually.
Yeah, and I think that the use of 110s for that purpose was never the intention of 110. It was never why 110 was brought in, but we do see it, the 110 used for that purpose purely to get to claim the deduction for interest. So the fact that these rules are there now will definitely, we would envisage it would reduce the amount of the application of that in certain cases. So I think that's one of the aims, I think, of these new rules. Okay. Well, I think with that, I think we're moving on to Pillar 2, and John.
Yep, thank you very much. Okay, so I'll be given about 15 minutes to talk about 160 pages of legislation. It's no easy task, right? So we're going to have to zoom through this, and to some extent, I'm going to assume a level of knowledge within the participants on the call around this topic. What I would say is that we are running a training and development session on the 21st, and many of you will have been invited to that already. And we can go through some of these topics in a little bit more detail on the day if needs be. Maybe let Mick, Kieran, and myself know in advance if there are any particular topics that you want to cover. The finance bill contains a very hefty section dealing with Pillar 2. Pillar 2 for entities that are in scope will now be effective from 1 January 2024 onwards, right? There are requirements with respect to the audit year end December 2023, and we will touch on those in a minute. And what I will try to do here is just emphasize some of the things that are relevant to people on this call in the short term. There's a full suite of rules that have come through: the income inclusion rules, the under tax profit rules, the domestic top-up taxes, and safe harbors and exemptions. So it's a comprehensive set of legislation, very similar to the OECD and the EU directives. It will impose a minimum effective tax rate for groups that are in scope, and groups that are in scope are essentially very substantial groups with turnovers of 750 million for 2 of the last 4 years. Maybe just move on a slide there, Mick. So from 1 January 2024, the section is now in play. Pillar 2 is effective. I guess the expectations as at the 1st of January will be that taxpayers will have done some level of impact assessment. This will be required as part of the 2023 audit year end. And there are disclosure requirements in the financial statements for 2023. So at a minimum, some level of assessment as to whether you're in scope and whether or not some of the safe harbors apply to you, and what you may think are the likely implications for Pillar 2. And then there are particular disclosure requirements as well. So that's coming at people pretty quickly. There are actually many leasing groups that will meet the 750 million revenue threshold, either on their own, on a standalone basis, or because they form part of a larger multinational banking group. There will also be investment funds or aircraft alternative funds, which will fall into the scope of these as well, because perhaps they may be consolidated into a larger multinational group, or they may be a joint venture, but we can discuss that again. Actually, Mick, if you could just go back for 2 seconds. Once you're through the initial impact assessment, you will then have your quarterly reporting will be starting probably for the first quarter, and that will run every quarter up to the year end. So you will be providing for taxes under Pillar 2 rules from 1 January on, with a reporting requirement for Q1, probably sometime in March, April. The first tax return isn't due until 18 months after the 24 year end, so that probably will be around June 2026. Thanks, Mick. Right, so the basics again, the 750 million threshold revenue. What you should be looking to do is determine who's your ultimate parent entity, where are they based? Does that jurisdiction also have Pillar 2 rules? If not, is there an intermediary UPE, ultimate parent entity, between you and the ultimate parent that adopts Pillar 2? Or is the intermediary location Ireland, in which case the Pillar 2 will be adopted and the application of the rules will be much more extensive for you. If you are part of a group of companies that has minority shareholders, or you are a joint venture among maybe two or more substantial investors, you may not meet the threshold test yourself, but because you are owned by a larger multinational group, you may be within the scope of, you may have various Pillar 2 requirements because the joint venture investor is within the scope of Pillar 2. So a bit of time needs to be thought about whether or not you're in scope and to what extent you are feeding into various UPEs. You then need to assess whether any of the safe harbors will apply to you if you are in scope. And there are various safe harbors in existence. The IRR is the first set of rules that clicks in. That's effective for 1 January 2024. The UTPR rules don't come into effect until 2025. So the focus for the current year and the coming year will be all about IRR. And that is important actually, because UTPR will bring in income from other locations, affiliates and sister companies that may exist in locations like the Cayman or outside of Ireland that are part of a broader group, but where maybe the parent doesn't adopt Pillar 2, it becomes an issue. So it's IRR is the focus for 24. If we anticipate we will be adopting the new regime has got a qualifying domestic top-up tax. So there will be scope for you to prepare top-up tax on the basis of your local financial accounting standards. But that, again, is something that you need to examine. And you need to think about the fact that Pillar 2 will have implications for broader transactions and business decisions. So it's something that you need to constantly be thinking about. Maybe, Mick, if you could move on the slide, thanks. So this is interesting. At the moment, the finance team goes and prepares the accounting profits. The tax team typically prepare the taxable profits, which is an adjustment to the accounting profits. There is now a third calculation to be done. You have to calculate your globe income. And that will be a version of accounting profits, and you will be making adjustments in line with what the legislation requires. The adjustments required by Globe are not actually necessarily the same as the adjustments required for taxable profits. So I would say that Globe income looks closer to accounting profits than it does to taxable profits. The things you need to determine for the year ahead will be, well, what systems and what data do you use and do you need, and who should be responsible for doing this? Strictly speaking, it is in the tax law. It looks like tax, but actually it may be something that the finance team needs to own and take ownership of after support in the first phase. There will be various global adjustments. There are plenty of them in the legislation. I guess the key ones relevant for this sector are the substance-based income inclusion rules, which we will go into a little bit more detail. And also the fact that transfers of tangible assets between constituent entities, between SPVs, for example, after the 30th of November 2021 must be rebased. There's cross-border financing arrangements need to be adjusted for arm's length principles. Be aware that there are a number of adjustments required for pre-law transactions between connected companies, and you need to take account of those. The good news is that deferred tax in your financial statements will be fully creditable against any top-up tax that you have. Right, so all deferred taxes provided in the financial statements prepared in accordance with GAAP or IFRS should be fully creditable. All unrecognized deferred tax assets that are disclosed should be fully creditable. So many lessors will have valuation allowances set against deferred tax assets, particularly as a result of COVID and various things around that. You need to make sure that they are properly disclosed in your financial statements so that you can get the benefit of those in the new environment. Top-up taxes, what will you do? Well, you provide your current taxes, your deferred tax on your GAAP profits as normal. You then provide top-up taxes on your globe income after taking credit for your current and deferred taxes. And the top-up taxes will be cash taxes and accounted for as current taxes. And there will be a requirement to pay something over to the revenue to the extent that you do have profits. So just to think about that, what happens if your ETA or your ETR in Ireland is around the 12.5%? Well, then maybe you're looking at a 2.5% top-up cash tax that will be due sometime in 2026. If you have a much lower effective tax rate in other offshore locations such as Hong Kong, Dubai, Singapore, Malta, wherever you have other asset ownerships, well, then you're looking at much more significant cash tax top-ups.
John, sorry, just on that last point. So that's, I suppose, in your view, probably a significant advantage then to the Irish regime versus some of the other regimes that are there. If you're saying that the 12.5%, the deferred tax on that is giving you some value from the Pillar 2 perspective, is that fair?
Absolutely, absolutely. And what you will see is probably some level of regime change in all of those locations to make them more competitive to Ireland as we move forward, Mick. If we can move on a slide, thanks. Just focusing on the substance-based income exclusion. The idea here is that if you have substance in your location, then you can reduce the amount of your globe income that is subject to the higher minimum tax rate, right? There are two relevant ones for leasing companies: payroll and tangible assets. So just to talk about those briefly for the moment, what you do is you determine what your payroll costs are, and you determine what your average carrying value of your tangible assets are, and you apply a percentage to it. And then the amount that falls out of that calculation can go to reduce your globe income, kind of euro for euro, dollar for dollar. In the case of tangible assets, the calculation is the excess of the average carrying value of your assets across the year over the right of use asset that is booked by the lessee. So there is a need to share your tangible assets with lessees, because there's a recognition that the tangible assets are in use by both parties, and therefore that benefit must be shared out. For tangible assets, there, however, does remain quite a bit of uncertainty around the availability of that carve-out, and it's based on the fact that the legislation requires the assets to be located in the jurisdiction of the entity that's seeking to avail of it. In the case, obviously, of mobile assets, and aircraft in particular, they are moving around multiple locations and may never ever be in the location of the constituent entity. So clarification on that point has been sought by the OECD, and as far as I'm aware at this point in time, that remains outstanding. It does feel that the appropriate approach would be that the industry would adopt something similar to IATA, which feel that the location of the assets should be where the residence of the asset owner is located, or the taxable residence of the asset owner is based. And it may be that OECD confirms that or doesn't confirm it, in which case the industry may need to take a position by looking at what IATA are doing and taking something similar on that. So that's certainly a big area of uncertainty and could have a material effect on the application of Pillar 2. Payroll costs, you get the benefit of those at a rate of 10% in 2024. Maybe just move on there. Okay, just turning to disclosures. So for the accounting periods beginning on and after 2023, IAS 12 has been amended. It doesn't require you to restate any of your opening balances or your positions on your deferred taxes for 2023. There's also recognition that you may not know the effect of Pillar 2 on your business as of yet, and therefore they don't want people going to recognize or disclose anything material around whether or not there's a big impact on the deferred tax assets and liabilities relating to Pillar 2 in the future. So there isn't a requirement to recognize any additional deferred tax assets or liabilities or reduce them, with respect to your assessment of how Pillar 2 may impact on your business. However, there is a requirement to make a number of disclosures. What they want you to do is essentially assess the impact of Pillar 2 on your business at the end of 2023 and disclose information, disclose what you feel is going to be the impact on your business for that period of time. It's both quantitative and qualitative. So they want information disclosed about how Pillar 2 may impact. Are you in scope? Will you get the benefit of a safe harbor? What locations your businesses are in that may be impacted by Pillar 2? And then they also want quantitative information to the extent possible. So, what, to some extent, what might be the exposure on the current year's profits, for example, if you were already in a Pillar 2 environment. So maybe just to flick on there for a second, Mick, I think I give a sample disclosure that's actually contained in the in IAS 12. Qualitative information, such as information about how the entity is affected by Pillar 2 and the main jurisdictions. And quantitative information, such as an indication of the proportion of an entity's profits that might be subject to Pillar 2 income taxes and the average effective tax rate applicable to those profits at the moment, or an indication of how the entity's average effective rate will be changed if Pillar 2 legislation has been in effect. If you are not in a position to actually provide that level of information, then there's also a requirement on you to disclose that too. So I think that is important to realize that there is some level of disclosure on you in the current period. So I will leave it there. I think people for 2023 Your deferred tax will remain at the current rate at 12.5% or whatever rate you provided. You will not be restating that for the impact of Pillar 2. And then you will be looking at appropriate disclosures with respect to your impact assessment. I think that's it, Mick.
Thanks, John. So I just might pause there for a second. I'm not sure if anybody has any questions or anything they want to pop in the question box. Appreciate a lot of information there. And as John mentioned, please feel free to reach out to us separately if you want to discuss it, and we can go through. Cool. So then might move on then, Kieran, just to the discussion on the new outbound payment legislation.
Yeah, cool. Thanks, Mick. Yeah, so the new outbound payments rules were in the finance bill as well. So just a bit of context on these. Ireland's commitment, I guess, under the National Recovery and Resilience Plan included a commitment to introduce measures dealing with aggressive tax planning. Most of those commitments have already been implemented in Ireland, but the last of them that's still pending, I guess, or was still pending, was the implementation of new rules on certain outbound payments. And that's what this is basically. And it also forms part of our legal commitment to secure funding under the EU Recovery and Resilience Facility following COVID-19. So that's the context to which these rules are coming in, and the commitment that was given. They're also specifically aimed at double non-taxation. So where you have, let's say, deductible payment going somewhere that isn't subject to tax. So just what we've shown on the slide here is just the basics of outbound payments legislation. So there are new withholding tax rules for interest, royalties, and distributions, on basically disapplying exemptions from withholding tax that would have otherwise applied. So they apply to payments of interest, royalties, and distributions to associated entities in zero tax or non-cooperative jurisdictions, and the non-cooperative being in the EU list of non-cooperative jurisdictions. So the payment has to be to an associated entity, and it has to be to a zero tax or a non-cooperative jurisdiction to be within the scope of these rules. And the application is that they turn off existing withholding tax exemptions. So you're subject to withholding tax when you wouldn't have been before. So the legislation applies for payments on or after 1 April 2024. However, there is a grandfathering provision. So if your arrangements or structure was in place on 19 October 2023, which is the date the finance bill was published, and the legislation will not apply until 2025. So there's a bit more time to think through that. So we can go on to the next slide, Mick. Yeah. So we have a brief just flow chart here on how the rules work and the different steps, I guess, you need to work through to determine whether these rules cause an issue for you in your structure within a leasing group. So first point is, do you have a payment of interest, royalties, or distribution? If the answer is no, obviously the rules don't apply because you don't have a payment to which withholding would apply. If the answer is yes, you need to think about whether it's a payment to an associated entity. Broadly speaking, associated entity is a 50% relationship through shares, profits, or voting rights, and that can be through a third entity as well. So you could be associated via a third entity. It's also possible to be associated via a concept called definite influence in the rules, which is similar to significant influence we would have seen in the hybrid rules. So you also have a concept of association that way as well, similar to hybrids. So if you're not associated, the provisions don't apply. Simple as that. If you are associated, you need to look at whether or not the entity you're paying to is resident in what's called a specified territory. So as you mentioned before, specified territory is a zero tax jurisdiction or a jurisdiction that's on the EU list of non-cooperative jurisdictions. So important, you have to tick both the boxes. So not associated, you're out. If it's not to a specified territory, you're also out. But if you do tick both of those boxes, you are in the scope of outbound payments. So an interest payment that ticks the boxes on those will be within scope, subject to certain exceptions. So if we flick onto the next slide, Mick, there's some key points here just to bear in mind as well. Just going from left to right on the slide before we get to a couple of examples of how outbound payments might apply in a kind of a leasing group or structure. On the left here, corresponding payments. So there is a provision in the rules where if there's a corresponding payment within a defined kind of time limit from the entity the Irish company pays the interest to onward to a third jurisdiction, that can be considered a payment directly from Ireland to the third jurisdiction. Where that might be relevant would be, let's say, Irish company makes a payment of interest to, for example, a Cayman entity. That would be, and let's say the Cayman entity is its parent. That payment is within scope. But if there's a corresponding payment out of Cayman to a third entity in a different jurisdiction, you need to assess it on the basis that it's a payment from Ireland to that third jurisdiction. So that can be helpful, and we'll see that on the next slide as well. Partnerships, you can look through the partnership to the individual partners to determine the treatment. And again, that's deemed to be a payment from the Irish company or PE to the partners, to the partners as opposed to the partnership. That only applies where the jurisdiction where the partnership is set up or established treats the partnership as a flow through, and that the income arises directly to the partners, and that the same treatment applies in the partner location as well. Possibly less relevant for standard aircraft leasing structures, but relevant maybe in an ABS context or so on. There's a knowledge-based test around quoted Eurobonds or wholesale debt instruments, where it's reasonable to consider that the company is not aware that the payment is going to an associated entity. The rules don't apply. So that would be relevant where you have listed debt and you really don't have any practical, you can't have any practical knowledge on either whether there's association or the tax treatment of the entities that are actually in receipt of the interest, for example. And then the final one here is on dividends. So the rules do apply to dividends. However, they're going to have limited application, because even if you are making a dividend payment to a specified territory from Ireland, generally speaking, that dividend will have been out of income that was subject to tax originally. And to go back to what I said at the start of this section, this is targeting double non-taxation. So where you're making a dividend payment out of taxed income, the rules don't apply. So if dividend out of taxed income, rules don't apply, and that applies even indirectly. So if you had a dividend from an Irish company to another Irish company above it, and then that Irish company made a payment to, let's say, a Cayman entity, provided the underlying profits in the lower tier sub were subject to tax, then the rules don't apply, because the basic premise here is that we're dealing with double non-taxation. We might just flick onto the next slide, Mick, and there's a couple of examples here. So one is, so just in the context of leasing, what we see, we would see this kind of structure, not wholesale in aviation, but we do see the structure where you have an Irish company funded with a listed note from a Cayman company. In this case, Cayman is clearly associated with the Irish entity, as it is the parent, and it's also in a specified territory. So the rules are applicable. So that interest payment from Ireland to Cayman is subject to outbound payments rules. However, as I mentioned on the previous slide, the corresponding payments rules may in certain scenarios be helpful here in mitigating the impact where there's an onward payment from the Cayman Co to a tax-paying entity above Cayman. So if there's not a corresponding payment, the structure is likely going to be caught by outbound payments, and you will be in withholding tax position in that case. And the way that technically works is that the exemption under Section 64 for a Eurobond, because in this case obviously it will be a listed note to Cayman, that is turned off, and basically withholding tax would apply. But if the Cayman Co has a what's called a corresponding payment to another entity in a different jurisdiction that maybe is taxable, then you treat that as a payment from Ireland to that third jurisdiction, and to the extent that that wasn't a specified territory, you may be out of the rules. And so that's a structure that we do see.
And you might be going on to explain this, but it's probably worth noting, to the extent that all of these entities have been somehow checked open or are for US tax purposes, and there is pickup at some level in the US, then it probably is okay as well.
Exactly, yeah. So there's provisions as well for where the income is treated as arising to US investors. That is also covered here in the rules. There's provision for that too. And the second example here, just on the right hand side of the screen, is again a common one we see around the Cayman LP. So we see this frequently in aviation, including like master feeder structures, including a Cayman LP aggregator type vehicle. We obviously have an Irish entity here. It could be a FinCo or it could be an AOE in leasing, which is funded from the Cayman LP. The Cayman LP is established in Cayman, and that's an important point to bear in mind. We don't have to be resident in the specified territory. Like the Cayman LP technically isn't resident, but it is established in Cayman. So that counts as regards to specified territory rules for outbound payments. So it is caught by outbound payments at a basic level on the basis that's associated with the Irish Co. However, where Cayman treats the LP as transparent in Cayman, such that the income, in this case, the interest on the note, arises directly to the partners, being partner A, B, and C. And each partner also views it as arising directly to them under their domestic rules. Then the payment is treated as being made from the Irish Co to the partners and not to the Cayman LP. And so that means the assessment moves from the Cayman LP level to the partner level. And that assessment is for association and then on whether the entity is taxed. So for just to take an example on that, if the LP in this case is treated as transparent, we look at each partner here individually. So we have an interest payment up to the partnership, but we're treating it as being paid to the partners. If partner A was owned 20% of the partner interests in this case, then absent anything else, that partner should not be associated with the Irish Co. And hence the outbound payments wouldn't apply to that portion of the payment. That's applicable to a partner A. So we don't need to think about how partner A is taxed on the receipt. If partner B, for example, had 60% of the partner interests in that case, that partner B would be associated with the Irish Co. So then the question becomes whether or not partner B is in a specified territory, are they taxable, etc. So you need to run that analysis. So in this scenario, you will need to assess each partner individually, and that can become complex at that level. And there are, I suppose, a number of variables to be considered both on the association piece and the taxability piece in terms of, where you fit in within those rules. So
Kieran,
I guess
is it fair to say, Kieran, that this has had an outsized impact on our thinking over the last couple of weeks, that it actually is going to be impacting on a number of our structures that we see. And
absolutely, yeah, like we're seeing it across a number of structures at the moment, and where it gets quite complicated as well, John, is like we have a structure on screen here where we have partner A, B, C. We could have a lot of partners coming into that Cayman LP if it's an aggregator. We could also have partnerships themselves coming into the Cayman LP. So you have partner A is itself a partnership, and then you're looking above that. So it is complicated, and we are seeing it in multiple structures across, I guess, the aviation space, both with Cayman entities or companies and with LP partnership style vehicles as well, and it is complicated.
Yeah, and I think we just to point out that where we're seeing issues in particular is where the partners are coming through a series of feeder entities. It's not the case that you just only have one Cayman LP and one partner coming in. Partners generally come through multiple feeder entities, some of which will be companies, some of which will be LPs, and actually the existence of the companies is going to make this incredibly difficult.
Yeah, and I think the structures we've been looking at, John, I think we wouldn't necessarily be able to fit them on the slide to show where we're getting to at the top. So it's I think it is complex. I think the rules themselves are relatively straightforward, but I think they have really complex application in certain cases like this. So I think the point to bear in mind as well is that clients do have and taxpayers do have until 2025 to assess structures, provided they're in place on the 18th of October. And I guess that's what we're focused on doing at the moment with clients. So there is time there to think this through and determine what the analysis is. But I think the time is now to kind of look at it, because I think it's quite impactful the way the rules are drafted.
And I think also, Kieran, there are quite potent anti-conduit rules within this legislation that would avoid you setting up an intermediary financing company in somewhere like Luxembourg or Malta to just flow the funds through there instead.
Yeah, there's specific anti-avoidance rules within the outbound payments provisions, and we've actually have discussions with Department of Finance and so on in advance in the context of the consultation around this, and certainly they are. It's clear that a interposition of an intermediary vehicle between Ireland and the specified territory, in this case, like on the left-hand side of the screen there, between Ireland and the Cayman company, is, potentially within that. So that's something that we need to bear in mind as well in the context of any restructuring or so on that we're looking at in the context of outbound payments.
Yeah, and that's important as well, John, because Luxembourg does not have the same breadth of rules because it brought in a more limited set of rules so that effectively you could continue to pay to Cayman. The Luxembourg rules are just focused on payments to non-cooperative jurisdictions.
Yeah,
They've been asked by the EU Commission to expand the rules, but as of yet that hasn't happened. But actually, because of how the anti-conduit rules will work under Irish legislation, that doesn't really help us hugely,
yeah,
because we can't just kind of use Luxembourg as an intermediary. So there will be, I suppose, a focus on that, and maybe our initial thoughts on what was a short-term fix may not be there, if those anti-conduit rules have worked against using Malta or Luxembourg.
And I think, Mick, you
yeah.
maybe mentioned as well in discussions that some ABS structures might be impacted by this. I'm not sure how exactly, but it's just one to bear in mind that there could be payments to associated entities or something.
Yeah, John, because like if you looked at some of the ABS transactions maybe that were done a couple of years ago, there was public offerings around the equity certificate element of those deals. But some of the more recent ones, there wasn't a public offering on the equity side. The public offering was only on the debt side. So therefore, the equity offering is probably held either within the group of the existing lessor or maybe held by one or two anchor investors who, if they're kind of private equity asset managers, will probably hold it through one of the two structures that we're seeing on this page. So that's kind of fairly important because just people would have walked through rules on anti-hybrid. If they use the Section 110, they'll have walked through rules on the specified person element, which are somewhat similar to these rules, but not exactly the same. So the fact that you don't have a hybrid issue or you don't have a specified persons issue is not definitive that you won't have a consideration here around structure that might turn off your withholding tax exemption. So yeah, you're right, John. Like some of those ABSs and also some of the ones that might be looked at for early next year, again, where there won't be a public placing of the equity certificate side of the deal, need to be aware of these.
Yeah, and I think Mick on the public side, I mean, we mentioned there the knowledge based test. I think that should look after a lot of the public element of it, where on the basis that it's reasonable to consider you're not paying to an associate, that should be okay. But it's that other element where it's a bit more nuanced, I guess, where you won't necessarily be able to apply that exemption.
So I see there's a question here just on the Cayman structure, and again, it's just to, I think it's just to reiterate the point that we made already, that above the Cayman LP, it's not uncommon that you would have maybe 2 or 3 or 4 layers of feeders entities, and those feeders might be in place to facilitate US tax planning, foreign tax planning, and to bunch off different types of investors that are coming into these structures, be it US exempt investors or super exempt investors or US taxables. The existence of those feeders, typically they're LLCs, is going to potentially pose fairly significant problems for making interest payments up to a Cayman entity. So to the person who asked the question, yes, that is something that does need to be looked at.
And just on that point, like even to take the simple example that we have on screen here, it is possible you could have an interest payment up to the Cayman LP here, and you get comfortable on partner A and B. Maybe one of them is not associated, maybe the other one is in a tax in a tax paying jurisdiction, but the partner C is associated and is in a specified territory, so the rules apply. What that actually practically means is that there's withholding on a portion of the payment. The interest payments are just important to bear that in mind, that it's not all or nothing. There could be if you were within the scope, it could be for a portion depending on the individual analysis for each partner.
Yeah, and Karen, sorry, I just want to mention one other small piece on it, because it ties back into the Pillar 2 discussion as well. I mean, what we have on screen here is probably more of an asset management, private equity type structure, but we also would have more corporate type clients who would have used financing through an offshore vehicle, for different reasons, maybe depending on where their parent was, maybe they had a listing, something where they were able to do that to change equity into debt and bring down their effective tax rate. And this obviously will challenge the use of those structures, and tied in with some of the Pillar 2 points that John made around, having pickup in Ireland for income that would have been offshore if your Irish entity is your ultimate parent entity. kind of questions there for whether there is an ongoing benefit of having the structure, and probably also kind of provides a reason for maybe collapsing that structure back onto an onshore jurisdiction. So there is some stuff in here in the outbound payment that would say, you would be fine under the rules if the payment was caught by the Pillar 2 kind of inclusion rules. But if it's caught by the Pillar 2 inclusion rules, you're going to be paying 15% anyway. So, that's going to collapse the benefit for you. So I suppose there's a number of points here to be aware of, that that isn't just in a more classic kind of hedge fund or private equity structure.
Yep.
And so maybe then, just sorry to move on, I'm conscious of time. John, maybe just in terms of timelines up to the end of the year.
Yeah, so I think the finance bill has committee stage was, I think, 2 days ago, maybe 3 days ago. So there will be a number of other stages through which the bill will go through, but it is expected to be signed by the end of December, which is the typical timing for the last number of years. So we'll have a Finance Act enacted by probably Christmas. And I think that's it, Mick, on that. So I think I see there was a number of questions in. I think we dealt with most of them, Kieran, and Mick.
Yeah.
I don't know if there's anything else there that I've missed.
The only other one there, John, just on what we were discussing around Pillar 2 is just, I guess, how we're dealing with it right now, or what we're doing in terms of assessing the impact of Pillar 2 right now with clients. I guess that's around, there's an interaction with the accounting treatment, and obviously you got your 750 million threshold, and I guess determining whether entities are in scope. That's really the key focus of attention at the moment, I guess.
Yeah, I mean, I think if you're a corporate and if you're part of a large multinational group or you're 100% subsidiary, I think you probably have a fair idea where you're at, actually. You're probably part of a larger group that itself is assessing the impact of Pillar 2. That's certainly large. There are plenty multinational groups that are now conducting an impact assessment and have maybe even progressed beyond that point. So if you're a subsidiary of one of those groups, you probably should be trying to see what the overall thinking is. I would say in that context, a lot of those multinational groups haven't focused on local requirements, right? They're looking at the bigger Pillar 2 assessment across the globe, but they're not thinking about what's relevant in Ireland. So if you are a tax person or a finance person located in Ireland, you need to plug into the broader thinking, but you need to realize that what's happening at that level may not actually take into account what actually will be required from an Irish perspective. The other thing I would say is that where it gets more murky or less clear is if you are an asset manager looking after a number of investment type funds, aircraft type funds, then you may not think you're within the scope, because you might feel that your investment fund doesn't meet the threshold, and therefore do you think that you've done enough. That hopefully is the answer for you, but I think you will actually need to do a broader impact assessment, because the status of your partners and how they might account for you or how they may consolidate you could impact, actually could bring you within the scope of the IRR rules and Pillar 2 rules, and give what I was trying to imply earlier is that if you're, let's say, a joint venture, or you have a minority shareholder, that might drag you into the realm of the space that you might otherwise not be in. So we think there is an expectation that you will be doing an impact assessment as well. So take the Cayman structure you were showing a while ago. That's a classic case in point. Do any of your partners drag you into the scope of Pillar 2, in which case you need to know how it affects you.
Cool. Very good. I think that was it on the questions, John, so I think we can close.
I think we're at the hour anyway, so maybe we'll leave it there, and I'll just thank everybody for joining us. I remind people that we do have another event on the 21st of November. We will try and play around with the agenda and make it different to this. If there's certain things that you want us to deal with, just let us know, please, and we will try and do it on the day. There's a variety of subjects on the day, including ESG, tax, and accounting updates. So we'll try and get to some of these points for you. Thanks everybody for joining, and reach out if you need some support on any of the areas. Thank you.
Thanks.
Thanks, guys.